Welcome back. Pretty much holding on to all their gains. So after hitting record highs and crossing the previous peak of 21,834, the markets haven't given up all those gains, still intact with about a 180, 190 point gain on the Nifty. The Sensex up about 660 points. Jyotivardhan Jaipuria, founder, MD of Valentis Advisors, is with us on the show. Jyoti, if you remember correctly, your bias was more towards manufacturing and the capex-related theme, which did very well in the whole of last year. But the way the investors are lapping up IT this morning, do you think IT is also an interesting space to look at? Is the worst behind in terms of the fundamentals? And how do you expect the technology sector to perform from here on? And how should it be a part of your portfolio?
So our whole bias has been buy local, avoid global. IT was coming on our screens, and I mentioned it a couple of times. It's coming on our screens now because it had underperformed and it had, become relatively cheaper. So it was coming up our screen, but we actually didn't really take a big position in it because I'm still a little worried about the US economy. So my view is that we probably will get some negative news from the US economy in the course of this year. So it is more the macro call that we want to stay away because that's probably where the disappointment will come. Results, of course, today have been great. And so, they've managed to do well in an adverse environment. To that extent, it just shows that the IT companies are still like very good in terms of the way they conduct their business.
Jyoti, hi. Good morning and good to have you on the show. So, this whole IT move has really inspired the market in a big way. Just to sort of tell us, how would you be looking at it? There were a lot of notes in the last couple of days calling for a bottom. I don't know if you agree with that kind of a thought process or not. And, there's been a big divergence between mid-cap IT and large-cap IT. Would you expect the large-cap space to start playing a bit of catch-up now?
Yes, in general, and it's true not just in IT, it's true, across all sectors. I think the large caps will start playing a bit of catch up because we've seen a very sharp mid cap rally through last year. So this is, like I said, it's true for the IT space, it's true for the non-IT space. So in general, I think, the large caps have become relatively cheaper. We probably will see this quarter as the quarter of the large caps, where large caps do better in IT. The results have been good in the sense that, the commentary was better than expected. The margins have been slightly better than expected. So to that extent, anytime there's a sector which is like universally underowned, that's where, the moves are much sharper because everybody's, trying to cut down their underweight positions or that at least a bit of weight to that sector.
And where are we in this buy local theme? It's done very well. But is there more to go? And in that, do you want to tell us the pockets where there is still value?
Yeah, Reema, so it's still not done. My view is that this is like a 5-year theme, so it's not done yet because I think India will still be the fastest growing economy next few years. Obviously, the easy money's got made, so now it is no longer easy. So some of the things which we owned earlier, we're probably trimming down some of our weight there. So for example, capital goods has done very well for us. Capital goods still looks interesting over a 3-year, 5-year view, but I think now the valuations are getting a little more stretched. So to that extent, what we may see is they need to deliver. The margin of safety is really gone away. You need to see the deliverance. You get that earning growth, they'll do well. But where things are looking relatively better, one is the banks. So the banks have done badly, as you see, for the last 1 year after doing great in the previous year. So banks, there are still pockets which are doing well. One is your credit growth, which is picking up. There'll be some NIM pressure, which we'll see. We saw it in the last quarter. We'll see it in this quarter. And that's what the market is worried about. But on the NPL front, they are fine. NPL will not be great. And there are a lot of banks we are getting very cheap. They've underperformed. They've done, they are looking cheap. And so banks is one space we are looking at, especially some of the smaller private sector banks which trade really cheap. The second area which, we still like is the cement space. So cement is struggling with pricing power, but basically the raw material costs have gone down. So to that extent, again, in this quarter also, we'll see EBITDA per ton going up for cement companies. But I think the big theme there is still going to be consolidation. So we've seen a few over the last 4 months. We think we'll see a few more consolidation happening in the next 6 months. And, as the big become bigger, structurally, it will get very good for the sector. So what we would be playing here more is the smaller companies which we think will get acquired. Most of these trade at like $70, $75 per ton. And most of the acquisitions, if you see, they're happening at $100 a ton. So that would be the other space in the domestic space we are looking at.
Okay, got that. Jyoti, finally, I mean, that's a call on cement. You seem to be liking some of the banks as well. What else? I mean, how is the overall portfolio placed right now as we start the year? And at Valentis, are you thinking of any changes, any tweaks?
Yes, so what we have done is pharma is one thing which we added last year. And we've been adding and we continue to add to pharma. So our call, and we were a little early on this call and it worked very well for us, was that the US generic space is starting to bottom out. The whole price pressure there is bottoming out. And because of that, we'll get earning surprises coming from a lot of the companies which are, selling to the US market. And mind you, these were the companies, this segment was struggling for 4-5 years. So, that's one space which we bought early last year and we continue to buy it. It's done well, but we still think that it is just the turn of the cycle. So there's a lot more money to be made. So that's, one thing which we continue to add. Again, over here, the other space which we continue to add to is the crime space, because that's something which has looked interesting to us for some time and we continue to do it. So this is another segment where we are adding continuously. Frankly, we've also been raising a bit of cash in the portfolio. So for the last 1 week, I would say we've been selling a bit just to add to our cash, and our belief is that probably over the next few weeks we'll add a bit more to cash, just to guard against that if we get some correction in the market, either due to global factors or due to something in India. We want to have some money so that we can buy cheaper. One other space I'll just highlight, which starting to look, it's come another down now, is the chemical space. So it's done very badly last year. As we see, there's a lot of pain. Our view is that still there's 6 months before a lot of the destocking in the dealer inventory system works out, but probably something which we want to buy a little early rather than late. So that's a space we are looking at on bad news to add to.
Jyoti, this has been a rich conversation, lots of insights. Thank you very much for joining in. Get into a break. On the other side, India's longest sea bridge, the Mumbai Trans-Harbour Link, is all set to open today. But how is it going to impact Mumbai's realty landscape? We'll discuss more on that on the other side.